Before you risk a single dollar, you run the checklist. That one habit, more than any clever indicator, is what separates a disciplined trader from a gambler. Today, we build the pre-entry checklist that ties your whole charting toolkit together. And then we add the layer that beginners skip and professionals obsess over. How to manage your risk. By the end, you will see why the smartest people in the market decide how much they can lose before they ever dream about how much they can make. Let's start with why a checklist matters at all. When you're about to put real money on the line, your heart rate climbs and a fast, emotional part of your brain takes the wheel. That is exactly the moment your judgment is weakest. A written checklist is how you make the calm decision in advance, so the scared version of you simply follows orders. The surgeon Atul Gawande wrote a whole book on this, the Checklist Manifesto, after hospitals found that a short list of simple checks cut deadly errors dramatically. Pilots do not fly on talent and vibes. They run the same pre-flight list every single time, no matter how many years they have flown. Your money deserves the same respect. So here is the entry checklist, and the good news is you already know most of it. Box 1 is the trend. Zoom out and confirm the stock is generally climbing because buying into a steady downtrend is just catching a falling knife. Box 2 is the zone. Mark your support and resistance so you know whether price is near a sensible floor or stretched up against the ceiling. Box 3 is Confluence. Bring in an indicator or two, the relative strength index especially, and ask whether several clues agree rather than betting on one lonely signal. Box 4 is the trigger. Look at the candles right at your level for a reversal that hints the move is ready. Box 5 is volume. Confirm that real trading is backing the move, not a quiet, untrustworthy drift. Trend, zone, confluence, trigger, volume. If any box is empty, you do not have a trade. You have a maybe, and a maybe is a no. Now we reach the part that truly matters, the part that keeps you in the game long enough to get good. Risk management. Most beginners spend 90% of their energy on the entry, asking how high can this fly. Professionals flip it. They spend that energy asking a colder question. If I am wrong, how much will this cost me? Because here is the brutal math of losses. If you lose half your money, a 50% drop, you then need a 100% gain just to get back to even. Losses hurt you more than equal gains help you. So protecting your capital is not boring caution. It is the whole game. The first tool is position sizing, and it is the most important idea in this entire episode. Position sizing simply means deciding how many shares to buy based on how much you're willing to lose, not on how excited you feel. The trader and author Alexander Elder, in his classic Trading for a Living, gives a simple rule. Never risk more than 2% of your account on any single trade. He compares small, repeated losses to piranhas, each bite tiny, but together they can eat you alive, so you cap how big any one bite can be. Van Tharp, who studied great traders for his book Trade Your Way to Financial Freedom, found something striking. It was position sizing, far more than the genius of their entries, that explained who survived and who blew up. The second tool is the stop loss, and the rule is simple. You decide where you will admit you are wrong before you ever buy. A stop loss is just a price, sitting below your entry, where you agree in advance to sell and walk away with a small, survivable loss. Setting it before you enter is the trick, because once you own the stock, hope creeps in and every reason to hold on suddenly sounds wise. The stop is a promise your calm self makes to protect your panicked self. The third tool ties the first two together, the risk-to-reward ratio. Before you enter, you measure two distances. How far is your stop below you? That is your risk. And how far is your target above you? That is your reward. A good trade offers at least 2 units of reward for every 1 unit of risk, and many traders want 3 to 1 or better. This single filter quietly throws out most bad trades, because a setup where you risk $5 to make 1 is a bad bet no matter how pretty the chart looks. Let's put it all together in one clean example. Say your account holds $10,000 and you decide, like Elder, to risk just 1% on this trade, which is $100. You find a stock at $50, and the chart tells you that if it falls to 48, Your idea was simply wrong, so 48 is your stop. That is a risk of $2 per share. $100 of total risk divided by $2 per share means you buy 50 shares, no more. Your target, up at a resistance level, is $56, a reward of $6 per share against your $2 of risk, which is a clean 3-to-1. Notice what just happened. The size of your position was decided entirely by your risk, not by your hope. That is the professional move. There are two more traps worth naming, because they quietly destroy accounts that follow every other rule. The first is putting your whole risk into a single idea, where you take 5 trades that are really the same bet on the same sector. So a bad day hits all of them at once. Spreading your risk across genuinely different positions is just position sizing seen from a higher altitude. The second trap is revenge trading, the urge to win your money straight back after a loss by jumping into the next thing twice as big. That is the moment the gambler takes over from the trader, and it is exactly when your checklist and your fixed risk percentage save you from yourself. A loss taken by your rules is a cost of doing business. A loss taken by your emotions is how the business ends. And this is where Warren Buffett's most famous rule finally makes sense. Rule number 1, he says, is never lose money. And rule number 2 is never forget rule number 1. He is not promising he never has a losing investment. He is telling you that protecting your capital comes first, second, and third, and that everything else is a distant fourth. The traders who last are not the ones with the boldest entries. They're the ones who are still standing after the market does its worst. But here is the honest truth, the one we always come back to. Even a perfect checklist and a perfect stop are worthless if you override them in the heat of the moment. The trader who sets a stop and then cancels it as the price falls, hoping it bounces, has thrown the whole system away. Risk management only protects you if you actually obey it when it hurts. The discipline to take a small, planned loss is the rarest and most valuable skill in this entire series. And so we arrive where we always do. This careful craft, the checklist, the position sizing, the stops, is genuinely how serious traders survive, and it is real, learnable skill. But it is also demanding, and it asks you to fight your own nature every single day. For most people, there's a quieter path that needs none of it. A broad, low-cost index fund, bought steadily through every high and low, manages its own risk through time and diversification, with no stop to set and no checklist to run. That calm default has built more lasting wealth than almost any trading strategy, and it remains the wise choice for the vast majority of people. So remember where we began. Before you risk a single dollar, you run the checklist, and the most important boxes on it are not about how much you might win. They're about how little you are willing to lose. Decide that first. Size your position to honor it, and you will already be ahead of most people who ever touch a chart. I'll see you in the next one. Until then, keep it simple, protect your capital, and let the small, planned loss be the price you happily pay to stay in the game.